Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 24, 2022, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers and the economic data from last week and this week, our favorite three asset classes, and how we are positioned on the short term for both equities and for bonds. So let's jump on in.
Okay, let's go over the top three market movers for October 24, 2022. Number one, we have a big week of corporate earnings again. A lot of the big tech companies reporting. Number two, we have housing data and the first revision of third quarter GDP. Number three, we have the chart of the week, which is the PCE year over year, and that's the Fed's favorite gauge. All right, well, let's talk a little bit about what happened last week. We had a nice little rally in the market. We had the Dow and the S&P up nearly 4%, while the NASDAQ gained over 5%. A lot of that had to do with two reasons. We had some strong earnings last week, but again, keep in mind they lowered the bar, they lowered the earnings, so it was a little bit easier for them to jump over, and the stocks have already sold off, so they came in a little bit better, so the markets rallied a little bit. But two, there was a Fed recession pivot. I use that word loosely here, the pivot word, because it means something else. They basically said we've got to avoid tipping this economy into a deep recession. So the market liked hearing that, and so the market continued to rally last week. But let's go over the performance for the major asset classes on a week and on a year-to-date basis. As you can see, a lot of the equities and we're up 2, 3, 4, and 5%, while the US dollar and the aggregate bond index sold off about 1%, commodities 1.5%, and Bitcoin was basically flat for the week. On a year-to-date basis, we still just have the US dollar and commodities, your only winners, while everything else is deep in the red still. All right, let's go ahead and talk about this week. We have another very busy week of corporate earnings. A lot of them coming from the big tech like Apple, Amazon, Google, Microsoft, and Meta, all scheduled to report this week. Here is a listing of a lot of the other companies and when they will be reporting. A lot of the major companies will be reporting again this week. All right, on Tuesday, we have the Case-Shiller Home Price Index for August. Last month's report was negative, and that was the first negative number, or the first drop since January 2019, and that is over 2.5 years worth of data there that's been positive until last month. Wednesday, we have new home sales. Right now, they're estimated for September to be 630,000 new homes, which is a drop from 685 last month and a major drop from 839 just less than a year ago, back in December of 21. On Thursday, we have the first revision again of the third quarter GDP, and right now the estimate's at 2.0. The Atlanta Fed has us at 2.9, and the Bank of America, their global research, has us at 2.5. But the thing to keep in mind, we were trailing about little over 1 to under 1% up until about the end of September. Then all of a sudden we got a revision, and Atlanta Fed and Bank of America raised their estimate for third quarter. A lot of that had to do with the PCE, which I will go over on the chart of the week. And then on Friday, we have pending home sales, which are estimated to be down again for the month. Last month, they were down 2%. They already are down 24% year over year. And then that PCE, which I just mentioned for September, we'll go over in the core estimates at 0.5 versus last month's at 0.6. But let's hit the housing data first. And right now, pending home sales are down 28% year over year through October 9. Okay, we'll get a revision here on Friday. And that is the largest decline since COVID back in May of 2020. Now, one other thing, we are also going through the seasonally slowest time for home sales, and that is October, November, December, and January. So we can anticipate those numbers dropping pretty dramatically over the next 3 to 4 months. So I anticipate continuing to see that happening. Well, when that happens, homeowners don't want to list their home when the demand is weak, which is exactly the period we're going through, and when mortgage rates and interest rates are rising, which is exactly what they're doing. So, as a result, new listings are down 19% year over year through October 9. So, again, we can anticipate seeing that drop. Everyone's just going to pull them off the market through the holidays and then hope that interest rates start to come back down and demand starts to pick back up as we head into 2023. All right, let's go over our chart of the week, which is our core PCE. Now, it has come in hotter, the estimates, 19 of the last 21 times. And guess what? It's estimated to go up, so it looks like it's going to be 20 out of 22. Now, because the PCE is a big component of GDP, if they're estimated to go up, that is why we went from 1 to 2 to 2.9 at the Atlanta Fed. So even though this number is coming out on Friday, we're going to know what is going to happen on Thursday because that component will go into the GDP. So even though the GDP may not necessarily be a market mover, it will foreshadow what we're going to see on the PCE, which is the Fed's favorite gauge. So this may be a very big market mover for Friday. All right, so let's go over the top 3 asset classes on a long-term basis. No change from last week. We still have T-bills, US dollar, and the commodities. So again, defense is on the field, the primary driver of this market. We may bounce, but they are still the leading 3 major asset classes. All right, let's go over on a short-term basis our bonds. On a year-to-date basis, our 10-year interest rate has gone from 1.55 to 4.21, a huge move on the bonds, which is why our year-to-date drawdown or year-to-date performance for the aggregate bond index is negative 16.5. And if you remember from last week, this is the largest drawdown in bonds in history or ever. And ever is a very long time. So again, we've been out of bonds the majority of the year, protecting our clients. And we went back to protect mode on August 29th, and it has dropped another 7% since we did that. So hopefully you have someone that's protecting you on the bond side. And so if you're retiring and may have a good chunk in bonds, hopefully you have someone that's watching that and protecting you. Otherwise, your portfolio is taking a hit this year. Equities. It's been a volatile year. We have the equities year-to-date drawdown at 21% year-to-date. We've been in and out of equities. The majority of the time we've been out of equities. We moved back to protect mode and out of equities on August 30th. The market has dropped again 6% since that time. And again, let's focus a little bit on where we are kind of over the last month or so. We broke the June bottoms here at the end of September. We went back up into our resistance zone, sold off again big time through October, and now we're back up into that resistance zone. So we've got to break that resistance zone before we kind of get a little excited about equities again. So we're right there in that resistance zone. So we shall see where we go here next week. Okay, that's it for the week. Again, thank you for joining us. Our next update is Monday, October 31st. So happy early Halloween. And again, as always, continue to subscribe, like, and comment on these videos, and we will get them out to you. And again, we do this so that we can give you some valuable information heading into the week. and hopefully that you're learning from this. So again, thank you very much. We look forward to seeing you next week. Have a great week trading.